This is the Value Investor Podcast with Tracy Reinick. All things value, all the time.
Welcome back, value investors. I have a special edition podcast this week because so many of you have been sending me questions about the energy stocks, and you want to know which ones should you buy. How can you use the Zacks Rank to find the stocks? So a lot of really good questions. I thought I'd just answer them all on one big podcast here on the Value Investor because I do consider energy stocks for the most part to be some good values out there. And so you can consider this your ultimate guide to the energy stocks. I've done at least 2 other value investor podcasts covering energy stocks, including ones where I showed where the insiders were buying, but those mostly covered the EMPs, which for those who don't know the lingo of energy stocks, EMPs means exploration and production. So those are the ones that'll see the most benefit from rising oil prices, at least direct benefit. So I've covered those a couple times, but this time we're going to take a look at everything, or at least more. I shouldn't say everything because this sector is so enormous. I would need several podcasts really to cover absolutely everything. But this time I am branching out beyond the EMPs. So we're going to take a look at a couple of other areas you might want to consider investing in. And one caveat too, while all energy companies, for the most part, are seeing a benefit as long as they're oil related from the rising oil prices, I'm pretty much keeping this at the U.S. level. There's a lot of international oil companies as well. I would tell you to take a look at some of those as well. I'm going to mention one of them, but there's some great plays right now in Canada and also in Britain and some other places. So this one is mostly going to cover American companies and the Permian, of course, but there's a lot of other good plays out there. So with that, let's get started because there's a lot going on and I want to jump right in. So big oil. Let's start there because I know most people, when they think of energy stocks, think of the big integrated oil companies. And what that means is that they have both upstream business and downstream. It can mean refining, chemicals. They're also drilling and getting it out of the ground. And sometimes, but not always, service stations as well. So these are the ones that, like I said, everybody knows, the Exxons of the world. And you can use the Zacks Rank to narrow down the lists of these companies. So I went on to Zacks.com and looked up to see how many companies are in the big integrated oil category, because it does have its own subcategory on there. And there are 13 companies. 5 of them are number 1 ranks, with that means the strong buy, and 2 are number 2s right now, which is the buy. None are number 5s, strong sells. So that's a good thing. And then everything else is mainly number 3s. I can't remember. I think there was like one number 4, but the number 3, kind of gets a bad rap because that's the hold. And while we do encourage you to buy 1s and 2s, because those are the strong buys and buys, and that means there's rising estimates, a lot of companies fall down into the number 3 category just in general throughout the quarter. And that is kind of like the bell curve grading you had in school. There's always just like the small percentage that got the A's and the B's. And then there's the big group that's in the C's. Well, C wasn't like failing or anything. It's not bad. It's not the greatest. It's just kind of in the middle. So that's where the 3 holds are. And I'm going to look at a couple of those on this show today. But we're mainly sticking with the 1s and 2s because those have the better rank. So on the big integrateds, one that definitely sticks out as the number 1 rank, and the one that most of us know, is Chevron. So it's got the Zacks number 1 rank. Ticker is CVX. It also has the value PE right now, which is just 14.8. I know I've mentioned it on the show before. Dividend yield 3.5%. Earnings expected to rise 130% this year, and then about 7% for next year. A couple of the other 2 that you would know of, Exxon, which I mentioned earlier, that's the number 3. And then BP kind of gets lost. That's over there, British Petroleum. And that's also a number 3. Exxon, PE of 17 right now, but it's got that dividend of about 4%. And BP, one of the cheaper ones, 13.7 is their PE. Dividend yield 5.2 still. Like they never cut their dividend, even during kind of the dark times. So it's still one of the highest of the big integrated oils. And earnings growth expected to be really strong the next 2 years, including, I think it said 77% for next year. It's got a great peg of just 0.8. So I'm just pointing out a couple of the names. Those are both 3s. Chevron is got the number 1 rank. So moving on to the explorers, because I know a lot of you want to be in those because that's where the most upside should be, although I have a warning about that, a little caveat, which I'm going to explain in a minute. But I did a search on Zacks.com for those stocks because they have their own category as well. And there are 77 listed in the exploration industry. 8 of them are Zacks number 1 ranks and 10 are number 2s. So right there, you're getting 18 stocks that you kind of have to go through and see what they're doing, where they're located, what their fundamentals look like, all that stuff. There are 3 Zacks number 5s, the strong cells. So there's a few more of those here, but mostly, again, everything else is number 3 holds. But 77 stocks, that's a lot. But I took a look at a couple of the top, or at least some of the top ranked ones, and one that stuck out to me that I know some of you have been real interested in is stocks of EMPs outside of the Permian. That's a little bit harder to find because the Permian's getting all the love, and that's that area in Texas where they're seeing record amount of drilling. But there's other parts of the U.S. which are also strong right now too, and we'll see benefit as that oil price rises. So this one is called Bonanza Creek, BCEI. And it's pretty small, 776 million market cap. So I took a look a little bit deeper at it. It's not in the Permian, like I said. It's in the Rocky Mountain region in the Wattenberg field. That's one of the main areas in the Rockies, and that area is actually holding up pretty well too. So in the first quarter, Bonanza had a production product mix, and this is important too for these EMPs, of 59% oil, 17% NGL, and 24% nat gas. So it's pretty heavily oil, and that's why it's got those rising earnings estimates, because as the price of oil rises and they're getting it out of the ground, so do their earnings. So their average price per barrel last quarter was $57.89. That was through March 31st. It's mostly been trading a lot higher than that. Recently, I think they might have some hedges too, but still, you got to like it. And I took a look at their financials at the end of the first quarter. It had liquidity of $182.5 million. Cash on hand was just $5.8 million. But they had a credit facility with $176.7 million. Borrowing available, they had no outstanding term debt, but had $15 million outstanding on the credit facility. But that's pretty good. You got to kind of watch what's happening with the debt loads with these small capped companies. Big earnings gains expected this year and next year, 75% in 2019. So this is where you find the big gains when the price of oil booms. Okay, and the good thing about the Zacks Rank, because you might not have heard of Bonanza, I'm sure you're all rushing out to go put it in your phone right now into StockTwits and be like, what is she talking about? But the Zacks Rank does allow you to uncover some of these small cap energy names you've never heard of before. But like I said, here's the caveat. You really have to do your research, because as I was looking through this list, I saw one I'd never heard of before. Well, actually, there were many, but one definitely caught my eye because it has a good name. So Eclipse Resources. ECR is the ticker. It also has the number 1 rank. But when I went to look it up, it's trading at $1.55. And I went, what? How could it, at this stage of the energy cycle, be trading at $1.55 and have the Zacks number 1 rank? So Eclipse drills in the Appalachians, in the Utica and the Marcellus shales, Southeast Ohio. It has a market cap of $469 million. So all of this seemed kind of normal to me until I saw what its product mix was. So it's mainly natural gas. They do drill a little bit of oil, but it's very small. So for that reason, because the price of natural gas is mainly hovering $3 or under, it's not that great for them. They're not seeing the big benefit from the crude rise, hence the $1.55 share price. And actually, they recently lowered their CapEx guidance for the year to $250 million from $300 to $320 due to the natural gas market. So that's why you got to do some of your research. You can't just think everything on a list of E&Ps is going to be, cashing in on the oil boom, because they all don't do that much oil. So definitely be looking around. Now, moving along to another area, obviously, is the Permian. Oh, wait, let me do one more non-Permian play, because I know you guys are all looking into those. So the other non-Permian play, but this is a Zacks Rank number 3 right now, is a company that used to be called Synergy. It still says Synergy on Zacks.com. I try to get them to change the names, but they're a little slow moving sometimes. We have the right ticker, though, but it's now called SRC Energy. SRCI is the ticker. This is one I actually do own in my own personal portfolio. Used to be an insider trader because some insiders were buying there a couple of years ago, and I really liked it because it was not in the Permian. So they're also in the Wattenberg field, just like Bonanza. They have a $2.6 billion market cap, though, and some of the analysts consider them to have one of the best balance sheets amongst these kind of mid-cap E&Ps. So they're much more heavily in oil. That's why the shares are on the move higher. Cash on hand of $72 million. Credit facility plus the cash on hand is liquidity of about $622 million as of the last quarter. So that's pretty healthy there. PE of just 9. Again, this is a pure play on energy prices, oil moving higher is this one. Okay, now let's turn over to the Permian, because that's a little bit different story. Now, while everybody wanted to own the Permian players, because why wouldn't you? Because that's where massive amounts of drilling is going on. Now, if you don't know, there's a lot of problems with the infrastructure. So it's almost like the story is too good. I know that sounds weird, but it is. And so they're feeling the growing pains. They can drill the wells, but they can't really get it to the ports or where the crude needs to go, or even to the refineries. So there's a shortage of truck drivers, and the piping system there cannot handle all the volume. Now they're going to build more pipelines, but that won't really be in effect until the second half of 2019 still. So they're kind of a little bottlenecked here. There's good things going on, but they can't get it out completely. So that's why some of these stocks, even with oil rising, have been a little bit depressed. Also, they're trading off of the Midland Cushing futures and not necessarily the WTI, because of these bottlenecks and all this other stuff happening. And that's a lot lower than what WTI is. It doesn't mean these companies aren't making money at this level, but these bottlenecks and all this infrastructure growing pains probably will be playing out for many more months here. So if you get a chance to buy some of these on a pullback, I would be doing so, because this is the area you want to be in, is the Permian. So I have a couple plays. Some of these are the popular ones. So EOG is one of them. It's a number 3, however. It's one of the big guys down there, 70 billion market cap. It's a little bit higher PE than it used to at 24 right now. But earnings growth this year, 358%. That's pretty stunning there. And 2019, another hot year of 24.6%. Now, these shares haven't come down all that much, but they're still up 12% year to date on EOG. And then turning to one of the other favorite names that's also a big player in the Permian, Diamondback Energy, gets talked about all the time by Jim Cramer and CNBC because it's got the FANG ticker name there, FANG. And they announced in June, just a little bit ago, that they secured transportation for 70% of the third quarter and 65% of the fourth quarter to the Gulf Coast. Because again, these are the problems. Like, they can drill it, they know it's down there and they're getting it out. But if you can't transport it to where the buyers are, it's not going to help you. But they have come up with a way to get it out of there. Investors like that a lot. And so the shares have been on a little bit more of a move here. But if you can get some of these a little bit more depressed, then that's a good time to do that. I also took a look at the actual rig operators because, again, if they are all rushing to get it out of the ground, you think something good would be going on with the rig operators who were hit really, really hard during the downturn. Like everybody else, they, with all those rigs being shut down, well, that's their business. And so that went away. And they were just basically trying to survive. So one of the big players that has at least 50% of its rigs in the Permian is Helmerich and Payne. Ticker is HP. They shares are down 3% year to date because 50% in the Permian, well, if they have to start drilling less or even maybe, capping some of those wells or whatever they're going to be doing to slow down production, that doesn't help them if 50% of their business is down there. So people getting all nervous. Oh no, it's bad. It's bad. But analysts think you should be looking at some of those if they sell off here too, because Permian is still where it's at. It's going to clear up the bottlenecks probably by second half of next year. So if you get a chance to get these on the cheaper, it's good. Helmerich and Payne actually pays a nice dividend. It's yielding 4.4% right now. So you're getting something for some of your patience with that one. It's got a P of 500 though. So it's a little high for the blood there. But last year, some insiders were buying at Helmerich and Payne when the shares were much lower because they were seeing the turnaround. One of their competitors, Patterson, UTI Energy, PTEN is their ticker. Those shares are down 24% year to date. They don't have a PE because they're not yet making any earnings. There's no earnings, but they are expected to be positive by 2019. So they're turning it around just like a lot of these companies are. 30% of their rigs are in the Permian for Patterson. There's 16 companies in the drillers, so there's much more than these. There's no number ones, however, and there's just 2 number twos. So Patterson and Helmerich and Payne both number threes, just holds, and that's probably because some of these, growing pains are now going on. And then let's turn to another area that's kind of similar to the drillerish type areas. This is just called field services. And this is where you get some of your big name service companies like Schlumberger, Halliburton, those kinds of companies. There's 35 that are in our industry here. So there's quite a few, some of which are more specialized than others. There's only 2 number ones, and most are number threes, with just one coming in as the strong sell number 5s. I took a look at Schlumberger because the insiders were buying there earlier this year, and they're number 3. The P is a little elevated now at 34 times, but they do pay a decent dividend, 3% yield. But the estimate's been cut a little bit for 2018, 2019. So analysts feeling a little bit of weakness there, but this is one of the big players at 92 billion market cap. So if you're interested in one of the players that is worldwide, then Schlumberger is one you should be checking out. But I also took a look at Carbo Ceramics. CRR is that ticker. Insiders were also buying there earlier this year, and they do the sands, plus some other specialized oil services type work. They're trying to diversify their business because they were mostly all sands, and then the downturn hit, and they're barely surviving. So a lot of danger with this one. They don't have a PE either. So here's what's going on with their earnings. So in 2017, they lost $3.77 a share. That's a lot. 2018, it's going to be a little better, down just $1.84. And then 2019, still down though, down 21 cents. So they are seeing gains in all 4 of their segments though. In the last quarter, revenue was up 42% because we are seeing the turn now. But, they're still trying to diversify their big business segments. They do expect all 4 of them to be up again in the second quarter. So that's a positive. And they keep telling us what their cash balance is, just to let you know that they have some. So because there is this danger, a lot of people thought they weren't going to make it. So they have a cash balance as of March 31st of $70 million. Still, these shares are down 12.5% year to date, and they're really volatile because I had to get out of them in the insider trader because they were up and they were down and they're under $10, and so they move all around. But if you have a stronger stomach or you're into trading, then this is one that you might want to take a look at as well. A lot of these ones definitely to take a look at. Now, remember, the Zacks Rank is a short-term recommendation. It's just 1 to 3 months, mostly based on the analyst estimates. So when those change, the rank can change, and the rank usually will change during earnings season, obviously. So that's when you get a lot of craziness with the rank. Also, keep in mind, it's easier for the smaller companies that have fewer analysts to get the higher rank. And so the rank tends to skew a little bit more towards the small cap type stocks. So for instance, it takes a lot more if there's 15 analysts covering Exxon to get them all to agree on the estimates and for that estimate for the rank to change dramatically. So that's why a lot of these large caps you'll see like with 3 rankings often. Usually sometimes right around earnings, you'll get that pop up to like the number 1 or number 2. But the small caps, sometimes you'll have the analysts just coming out. If crude reaches a certain level and they start changing their estimate, it might only just be one estimate that's changing, and then you get the change in the Zacks Rank with them. So keep that in mind if you're using the Zacks Rank to find these stocks. There's all these little quirks to the Zacks Rank. It is very, very helpful in narrowing this long list of stocks into ones you might want to watch, but you have to know kind of what its good parts are and what its bad parts are. And also remember, today's show just is covering a snippet of what's going on out there. That, like I said, there's 18 Zacks number 1s and number 2s in the EMP space alone. And then there's all these other various areas. Plus, there's actually some areas that I didn't cover that are not technically in energy, but are influenced by it. Even the railroads, as far as transportation, the trucking companies, you'll see a lot of the pumping type of companies. There's chemical companies that make chemicals that go into the pipelines that make it easier to pump things through the pipelines. They're seeing huge demand because, again, the Permian, they're trying to get as much volume into those existing pipelines in the Permian as they can. So there's all these weird little side businesses that you never think of, even strangely like home builders or even staffing companies, because there's real low labor. There's a labor shortage basically in oil industry right now. So that's also impacting the Permian. But keep an eye out for some of those kinds of plays on rising oil prices. Of course, to get the most direct benefit from just simply crude rising is the EMP category. And that's why I've covered it so much here. But there's still some interesting other areas. And if you want to be a little more defensive, the big oil is the place to be because it has all the components. It'll have the refining and the service stations, the chemicals, all the components. And that's good in the downturns. You get more diversity in the business model there, but you won't get quite as much of the upside, obviously, for those. So keep that in mind. There's a lot going on. And remember, those ranks will change during the earnings season. So keep an eye on that. And remember, they're short term. So for some of you who are planning on holding these for the longer term investments, like I like to do, then the rank is not quite as vital once you're actually already in the stock, although I always keep an eye out on the ones that become number 5s, because that means those estimates are being cut somewhere, and I kind of want to know why, if that's the case. So keep an eye on those. But otherwise, I'm sure I'll be doing more shows on the energy stocks, of course, going into the future. I know you're all wanting to know how to play it and what's going on with it. So this is just the start of the ultimate guide to investing in the energy stocks. And I'll be doing updates as it goes along, especially if I see those insiders buying. There has been some insider buying earlier this year, as I mentioned, a lot in those services companies. So the insiders will buy in the beaten down stocks, and that might be where some of the deals are. So let's recap the tickers because there's pretty many of this show. So we had Chevron, CVX. I mentioned Exxon, it's XOM. British Petroleum, or just BP as it likes to be called, is BP. Bonanza is BCEI. Eclipse is ECR. EOG is EOG. Diamondback is FANG, FANG. Helmrich and Payne is HP, not to be confused with HPQ. I've done it. I know it's easy. So don't put that Q on there. It's just HP. Patterson is PTEN. Schlumberger is SLB. Carbo Ceramics, CRR. And SRC Energy is SRCI, and that's the one I own in my own personal portfolio. I have a couple other energy companies that I didn't mention in my own personal portfolio today, but they didn't come up in today's show. So, but I do own SRCI. So again, make sure you subscribe because you don't want to miss a single episode. We're covering all these kind of hot industries, even on the Value Investor podcast. So there's some value in some of these industries that are making a turn, both retail and now here in energy, and we're going to cover it all. So subscribe to us on Spotify. You can get us on Apple Podcasts, which is iTunes, and we're on SoundCloud, but you have to find us under Zacks Market Edge over there. So maybe you just want to be on iTunes. We got a standalone show over there, so you'll only get the Value Investor if you're over there. But find us somewhere and don't miss an episode, and I'll be back again next week with some more value stocks.